Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Today, we take a look at two stocks on the manufacturing one sector, Angostura Holdings Limited and Unilever Caribbean Limited. Let's first take a look at Angostura Holdings Limited. And for its financial year ended 31st December 2016, Angostura reported an earnings per share decline from 80 cents to 59 cents per share, or a 26% drop. This would have been driven to some extent by a revenue decline of around 4.5% from $649 to $620 million, and an increase in selling and administrative and marketing expenses overall. Excluding legal expenses, total expenses would have been $27.7 million, or 16% higher, moving from $170 to just under $200 million. And there was, in fact, a one-off legal expense incurred of around $16 million in the financial year. Profits before taxes, therefore, were around 20% lower, from $218 to $171 million, and inclusive of a higher effective tax rate from around 25% in 2015 to around 29% in this most recent fiscal year. Profits after taxes declined 25.5%. So let's take a closer look at the revenue story. And as we can see, revenues for Angostura Holdings Limited have been on somewhat of a downward trend from 2014 to 2016, with total revenues in 2014 amounting to just around $672 million, and in 2016, currently just around $620 million, as mentioned before. And that's around a 7.5% decline. And as we can see, the two major business segments for Angostura, its branded trade, which is sales of its rum products, etc., and its rum commodity trade, would have declined in almost a proportionate measure, around 7.5% each. So this could have been driven to some extent by the decline in demand locally, given higher taxes which would have been placed on alcohol as well as cigarettes, but alcohol applicable to Angostura in the last quarter of 2016 fiscal, and that would have contributed to some extent to the 25% drop in revenues which Angostura would have experienced in its last fiscal quarter. Looking ahead, the environment will continue to be challenging, but on the positive side, Angostura does remain a net earner of US dollars, which would bode well for its valuation and in the eyes of its shareholders. Compared to the rest of the sector and trading at a price of $15 per share, Angostura trades at a trailing price earnings multiple of around 25 times PE, which is above the sector average of 22 times, and also offers investors a trailing dividend yield of 2%, one of the lower dividend yields in the manufacturing one sector, and well below the sector average of 3.3%. On the basis of a strong international brand, but tempered by falling revenues and slightly above sector average valuations, Bourse maintains a neutral rating on Angostura Holdings Limited. Taking a look at Unilever Caribbean, or UCL, the company reported earnings per share of $1.62, a 4.7% decline from its fiscal 2015 results of $1.70. Now, on the revenue side, revenues actually increased year on year about 3.2%, from $548 million to $566 million, while cost of sales grew at a less than proportionate rate, just about 1.7%, from $332 to $338 million. Gross profits were up around 5.6% as a result, and operating expenses increased just about 6.8% year on year. Profit after taxes, however, were down 4.6%, as we can see, and this was driven primarily by an increase in its effective tax rate year on year from 25% odd to just about 30%. Now, Unilever, again, as a distributor in the main of fast-moving consumer goods, will face some challenges in the Trinidad and Tobago market, which accounts for around 60% of its revenues because of, again, the constrained economic conditions and overall weaker consumer demand. And as we can see here, the company has been doing very well in terms of maintaining their gross profit margins in the blue columns at around 40% for the last 4 years, whereas higher taxes and expenses, etc., would have contributed to lower operating margins in the red column, falling from about 14.7% to around 10.8% in 2016, and lower net profit margins as well, from 12.2% in 2013 to just around 7.5% in 2016. So some headwinds which may be faced. So at a price of $58, UCL is trading at a trailing price earnings multiple of 35.8 times and does offer investors a dividend yield of just around 2.2%. Again, compared to the rest of the sector, it is the highest relatively valued stock and offers on the lower end in terms of dividend yields to investors. So on the basis of constrained economic outlook in its major market, Trinidad and Tobago, and it's being the highest valued stock on the manufacturing one sector and a low dividend yield, Bourse maintains its sell rating on Unilever Caribbean Limited. That's it for this week's edition. For more information on these and other investment themes and ideas, visit our website at www.bourseinvestment.com. Give us a call at 628-9100 or email us at invest@boursefinancial.com. Have yourselves a great investing week. This has been the Bourse Report.